Good afternoon, everybody. I hope you're doing well. I wanted to take some time and give you an update on the COVID-19 and kind of go over where the markets are at right now. We thought we would do a web series, host these. Most of you just definitely don't want to see what we look like now with basically no barbers or anything like that. So we're going to go through the presentation. And if you have any questions, please feel free to email me at andrew@whalenfinancial.com or info@whalenfinancial.com as well. So we wanted to start these weekly webinar series. Feel free to distribute these to any of your friends or family members that may have questions about the market or what's going on in the economy. And we will be updating these on a weekly basis as we get through this pandemic. So first, some important disclosures. I'm going to leave those up on the screen. This kind of makes the attorneys happy. All right, let's get right into it. So Warren Buffett famously said, "Be greedy when others are fearful." So you can see right here, this is the fear and greed index. This is the indicator that basically tells us where the sentiment in the market is. And you can see 1 year ago, we were in greed right around the 60 level. You can see here. 1 month ago, we were still in there about 56. 1 week ago, we jumped right into extreme fear, and the previous close was a little bit lower. So you can see we're basically flatlined down here at extreme fear. And what that sometimes it mentions is, so for some investors, sometimes the right thing to do is the thing that feels most uncomfortable. So this is somewhat of a bullish sentiment. When we see this extreme fear gauge this far, we've seen it a couple of times during recent market corrections. And it's generally been an indicator of something to look at when deciding when to start placing new assets into the market. But it's good to be prepared, right? We always want to be prepared. This is exactly why we do these things. And you've probably been to a grocery store and seen the empty rolls of toilet paper, so it's always good to be prepared. Now, like I mentioned when we first started talking, the reason why I'm not doing a video segment on this is I haven't seen my barber in about 3 weeks. And a lot of people are starting to say that I look a little bit more like Tom Hanks from Castaway than myself lately. But with all jokes aside, let's get right into it. This is the fastest bear market ever for the Dow Jones Industrial Average. You can kind of see here the different dates of different bear markets in previous histories, going all the way back to 1917, and looking at the trading days it took to reach a new bear market. So you can see on average, it's about 40 to 50 days. If you summarize these numbers, this one, it took us only 19 days. So it's the fastest bear market ever for the Dow Jones Industrial Average. And it's an indication on how serious we took this, at least the market took it, as far as the ramifications on how much this COVID-19 virus could impact the overall marketplace and the economy. So if we look at previous outbreaks, that didn't really impact the markets as much. So over here on the left, you can see the different outbreaks, whether that's SARS, bird flu, swine flu, Ebola, Zika, and then the current coronavirus. You can see the dates of who declared them a national emergency, and the change in the markets. Let's go back. And the change in the markets of the S&P 500 1, 3, and 6 months later. So you can see SARS didn't really have a meaningful impact. Now remember, SARS hit April of 2009. That was right after the financial crisis. The financial crisis, or the bottom of the markets, was March of 2009. And you can see a big difference here compared to previous outbreaks, where you see these declines initially with regards to bird flu, but clearly coronavirus, which was down about 35%. And this number, we just haven't updated it yet, clearly reacting a little bit differently than previous outbreaks. So the good news is that stocks historically are resilient to crises. And you can see the batting averages 1, 2, 6, and 12 months later after the reaction of a crisis. The large numbers are relatively positive on these dates out in the future. So the batting average represents the number of positive occurrences as a percentage of the total number of occurrences with regards to historical gains. And this goes back from 1907 to 2019. So a little bit of positivity when you look out, 6 months or 12 months from now, from kind of where the markets are going to be. If we compare the current outbreaks to the past pandemics, if we look at, is history going to be any kind of indicator looking at, 50-year flu outbreaks, the stock market performance during the previous pandemics, you can see H1N1 of 1918, 33% market loss, 50 million global deaths, 675,000 US deaths. The 1968 H3N2 pandemic, the market dropped 36%, 1 million global deaths, and 100,000 US deaths. So this is actually as of today. We updated these numbers. The stock market loss was right around 34%. As of today, total global deaths about 58,000, total US deaths 6,921, and I'm sure that number's actually changed since when we completed this just right as the market closed. But this kind of gives you an idea of comparing past pandemics and the current COVID-19 virus. So here's basically the forecast for 2020. And we've got, prior to the outbreak, of what we were looking at for US GDP growth in the United States, roughly at 1.75, the revised base case scenario, and then we always give a revised bear case. So kind of a worst case scenario. So what we're seeing is, prior to the outbreak, we were seeing somewhere between 1 to 2% GDP growth rate. Last year, we saw a 2% annual GDP growth rate. But we revised that base case down now to roughly about 1 to 1.25% as our base case scenario, with a bear case scenario being somewhere between 0 to 0.5%, where we're looking at a lot of the developed ex-United States nations having a potential to show basically zero growth. Emerging markets should still see some growth inside of them. And on the global economy, this is still a little bit optimistic, where we're looking at roughly 3.5% GDP growth for the year. It's a little bit closer to 2.5 to 2.75, and even in a bear case, 1.5 to 2% on a global basis. And when we come down to the US market forecast, prior to the COVID-19 outbreak, we were targeting about a 3,250 to 3,300 S&P 500 fair value year-end target. We've revised our base case to about 3,150 to 3,200, which is pretty significantly higher than where we're at today. I believe the market closed today at, I just want to get this number for everybody. The market closed today at roughly 2488. So that's almost 600 points, 700 points higher as our base case scenario. But we always have to put in a bear case in there, 2200 or lower, as far as how far this market we think could drop. So we think it potentially could go another 200 points lower or so, which would be about a 10% decline from here, which we would then retest those lows, and which I'll pull up a chart towards the end and kind of look at where the market is, where the indicators are, what we're kind of tracking on the S&P 500. But the bear case, as far as on the low side, roughly 2,200 for here, and end of the year scenario, 3,150 to 3,200, which still gives us a pretty decent amount of room to run for the upside. So here's our road to recovery playbook. So these are the 5 indicators that we're looking at to try and look at when a market potentially could bottom. And when we look at past pandemics, what we've noticed is typically when you see those peak infections, about a week or so, give or take, is historically when the market has bottomed. If you look back to 1918 and that pandemic, it was about a week after peak infection rate peaked here in the United States when the market finally bottomed. So let's go through a few of these things. So number 1 is confidence in the timing of a peak in the new COVID-19 cases in the US. So we're still monitoring that on a daily basis. We definitely haven't seen that here. Potentially, we could have seen that in areas such as Italy and Spain, where we have seen some of those daily active cases start to come down slightly, which could be an indicator that we may be reaching peak numbers in those countries. So number 2 is visibility into the probability and severity of a U.S. recession. So we're almost there. We can basically put at least a high probability that we are going to have a negative GDP in the second quarter. And we're trying to calculate what that severity is going to look like from a recession standpoint in Q2 and Q3. Number three is markets have priced in a US recession. We're already there. So based off of where the market's currently trading at now, we're already pricing, if we look at earnings in different companies, they're already pricing in a US recession. So let's check that one off the box. Number four is sentiment and technical analysis, and it indicates a limited number of sellers remaining. So we're already there. So if you look at the sentiment, or what's called as the relative strength index, or RSI, anything below 40 is generally indicated as oversold. And anything above 70 is considered overbought. Right now, the market is currently trading with an RSI close to about 33, hit about 28 or 27 on those March 25th lows. So the sentiment's already there, and the technical analysis indicates a limited number of sellers remaining as far as throwing the baby out with the bathwater. So that one we can check off. Number five is policy responses have been sufficient to restore confidence. It seems like the $6 trillion, and just for those who don't understand how large the number trillion is, if we started right now, we tried to count to 1 trillion, just count to it. The number 1 trillion, 1, 2, 3, 4, 5, all the way to 1 trillion, it would take us 31,000 years, just a little bit over 31,000 years to count to the number 1 trillion. And they've just done that 6 times to 6 trillion, 4 trillion of which is going to go to the Fed, 2 trillion is initial stimulus package, which just was passed in what's called the CARES Act, to go directly to businesses and citizens of the United States as far as stimulus checks. So that policy response seems to have at least put a soft bottom in the market. We'll see if more initial response is going to be required as far as additional stimulus packages, but it seems like we're already there. So of those 5 that we're currently following, 3 of the 5 are already checked, and these 2 are the ones that we're really monitoring, and we're getting close, at least on the visibility or the severity of a U.S. recession. But we don't want to quite check this one off yet, because we need to kind of determine how fast the jobless claims numbers are going to grow, and how long we're going to be shut down. As you know, the president just extended to April 30th as far as the basic lockdown for the country, which is an extension of about 2 weeks. So as we get closer to that time frame, we'll be able to tell where we're at in this cycle to kind of gauge when the economy can get back up and running, which all relates to the potential severity of a U.S. recession. So containing COVID-19, like I said, is key to a market bottoming process. What this basically looks at are new cases in the rest of the world minus the U.S. So if you look, the yellow lines are the rest of the world minus the U.S., and the blue lines are the U.S. Now, this is only to the end of March, so obviously these numbers have changed. But what we can see is, in areas like Italy and Spain, where some of the, really tough areas that have been decimated by this virus, have potentially seen a peak in infections. Now that can obviously change, but the Italian families, where you have the brother and the sister and the mother and the grandparents and the uncles and the aunts, and the nieces and the nephews all living in one roof to take care of each other, which is just, that's their family culture, that really caused a bigger problem there, versus typical social distancing, which is what we're really starting to see here in the United States. And based off of the estimates that we're hearing out of Harvard is, sometime around the middle of April. So, and that's what they've been saying generally. So we'll see if we can get there, but containing the COVID-19 is key to the market bottoming process. As I said, in history, that is absolutely one of the key indicators to kind of looking at a bottom in the overall marketplace. And the question is, are we already in a recession? So if you look at credit market, the credit spreads, which is the spreads between high yield bonds and investment grade corporate bonds, that credit spread is a gauge on underlying risk in the economy. And the credit spreads are already recessionary, essentially. So what this chart looks at is the spreads between corporate bond yields and treasuries. And they basically widen significantly, but remain well below peak levels of the 2008 financial crisis. So like I've told a lot of clients over the last few weeks, is this is completely different than the financial crisis of 2008. where it was really a liquidity problem in the overall marketplace where people were making runs on banks. Banks didn't have enough financing to open the doors on a Monday trading, and required significant amounts of stimulus just to be able to cover expenses to open their doors so their stocks wouldn't plummet. And during the height of the financial crisis, you could see this credit spread jumped all the way up to, roughly 23 or 24. And right now we're only in the 10 to 15 range. So I'm not saying that it's not as severe. It's just the credit spreads are basically already pricing in a recession. So that's one indicator that we're looking at to see the overall health of the bond market, because if we don't have a healthy bond market, we can't have a healthy stock market. And a lot of things are going to significantly impact this, like if we can get oil to finally stabilize. There's a tremendous amount of energy corporations out there that have a tremendous amount of debt that they've run up over the last 5 or 6 years. And if oil stays in these key low levels, then it could be detrimental to those bonds or those credits that were issued to those energy companies over the last 5 to 7 years. So it's just something that we're absolutely watching. And it was kind of a double whammy when oil prices fell. I believe they're down about 55% from the start of the year. It'd be nice if gas prices fell by 55% as well, but I think the refineries have something to do with that. So not all bears are a recession, even though I did tell you earlier that, we have a high probability that we will see a recession. Now, recession is a technical term with 2 back-to-back quarters of negative GDP growth. That is a technical definition of a recession. So we could see negative GDP growth in the second quarter, which is what we're absolutely estimating. Some estimates out of Goldman Sachs have told us that potentially see flat GDP growth in the third quarter. Now, if that happens, then that will not be a technical definition of a recession, but it will definitely feel like a recession. But if you look here, this goes back all the way to 1946. And you can see the length of the typical bear market is averaged about 12 months. And the typical decline in the S&P 500 has been roughly 30%. With no recession, if a recession doesn't occur, the bear market is typically about 7 months. And the typical drop is about 24%. So we dropped 34% we dropped 34% in 19 days. So from February 2020 to March of 2020, we've only been in it 1 month, and we saw that 34% decline just because of the severity of this versus other past recessions where basically the economy is 100% shut down, or at least a significant percentage. And will we have a recession? That's why we have a question mark. We're not sure. We think that the probability is high. It all depends on how quickly the economy can get back up and running. And how confident consumers are to actually get back out there and not only spend their dollars, but interact with other members of society in ways that we would have before to circulate those dollars to the economy. So this is something that we've been talking about a lot over the last, let's say, week. We took selective positions in some areas with some clients that wanted, a high level of risk of picking up certain equities at low prices, when the market bottomed roughly around 324. But overall, generally, what we've been saying is that it's not typical. It is typical to see what we call bear market relief rallies. So at some point, some people call it a dead cat bounce, where the market gets so low that you have what was called a relief rally. So what we wanted to point out here is that even though we still think the market is going to trend higher throughout the year, there is a high probability that the marketplace will actually see some form of a decline back to those potential lows that we saw on the 24th before rebounding higher. And if you look here, this goes back to 1956, and it looks at the bear market peak versus the bear market bottom, how long it lasted, the S&P 500 return during that period of time, and how much we got in a bounce. Okay, so just so you know, the market was down 35% at the bottoms. and now we're down about 19 or 20 after today's close, probably about 20%. So that's about a 15% bounce. And you can see the average is right here, 14.5. The median is about 12, but the average is about 14.5% off of those 35% drops in these specific bear market bottoms. So expect these choppy markets to continue until we can kind of see those peak numbers really start to come down, or what everyone's calling is flattening the curve. So I wouldn't be too greedy as far as, hey, let's place a tremendous amount of money. But what we've been looking at is over the last 2 or 3 years, the majority of our clients we've positioned. So we have a relatively conservative bucket that pairs with any kind of equity or stock risk that we've been taking. And it didn't look good in years like last year where the equities were running up, 30, 35% in some of the portfolios. And we had the conservative bucket only up, 5 or 6. But it's these kinds of years that we really look at that conservative bucket and say, wow, we're really glad that we kind of hedged some of that risk. So in some portfolios, we've actually been taking portions of that conservative money and trying to dollar cost average over, let's say, a month period of time, because no one can pick a perfect timing for a bottom, but we do understand that equities are, undervalued to historical norms, and we would want to be able to take advantage of that versus just trying to time it. So I know you may read a lot of things on CNBC or on CNN or Fox Business, and I can just tell you that I've got an inkling that, we have a probability to retest those lows, and not to take it too big of a gamble and chasing, the 15 or 17% run-ups that we've seen just since those bottoms on March 24th. One good sign is that we're nearing what we call washout prices. Now, this is as of the bottom of the market on 325. And the nice thing about this is how much as a percentage are above the 200-day moving average. So 200-day moving average takes the stock price and it averages over 200 days, and it kind of gives you a nice little trend line. And what this says is only about 5% of all S&P 500 companies were above their 200-day moving average. So that means 95% were actually below. And that gives us some kind of an indicator. You can look back here on previous dips. If we go back to prior to the election of 2016, before the Trump administration took over, we almost had that recession, back-to-back negative quarters of GDP. The market dropped right here. You can see that. And you can see that same washout, or how many stocks were actually below their 200-day moving average. If you go all the way back to 2008, at this level here, right around that 3% number. So very few companies were actually trading above their 200-day moving average during the financial crisis. And you can see we're starting to test these numbers from here to here, like what we were before. And I just want to see if I can do this. You can see this nut line, and you can see where it is here. So they're pretty close. That's not the straightest line, but you can see basically the washouts that we've seen in the marketplace. Now we're actually probably right around here now after the recent rally, but it kind of gives us an indicator that it could be a bullish indicator of potentially moving forward. So the Federal Reserve definitely stepped up. They actually have the authority to buy almost any kind of asset class that you can think of, whether that's ETFs, whether that's treasuries, whether that's credits. They have the ability to basically buy almost anything other than direct equities. So what they did is they lowered rates from basically to zero. The Fed funds rate is 0 to 0.25. They opened up bond buying, which will now include commercial mortgage-backed securities. So if you think about the huge boom that we saw in commercial mortgages over the last, let's say 7 years, and a lot of those retail companies are completely shut down, not paying rent, right? I'm sure everyone saw in the news, the Cheesecake Factory basically said they're not going to pay rents on April 1st just because they don't have the money. Well, if they're not paying rents, then the commercial mortgage companies aren't collecting those rents. And it really messed with the commercial mortgage market during the height of this pandemic that we saw in the markets. from middle of February to the end of March. So they actually can step in and support that market now. They're also providing short-term loans to push cash into money markets. Clearly people during panics need or feel the need to go to the bank and deposit and pull out cash. So they're stepping up behind there to provide support to those money market accounts so that there's no problems. They lend money for purchases of securities backed by consumer debt, so i.e. credit cards. Main Street business lending program for small and mid-sized businesses. Unprecedented facility for bridge loans to large companies. They expanded bond purchases to highly rated corporates. They're currently doing currency swap lines to keep the dollar funding available overseas. They're providing loans to different municipalities. They have a commercial paper funding program and expanded collateral for dealers to some stocks, municipal debt, and highly rated corporate bonds. So before you had to have the collateral of just only U.S. Treasuries. They've expanded that collateral for some dealers so that they can potentially limit margin calls on certain asset classes. And then they are supporting short-term liquidity through expanded repo market funding. But basically what they did with this $4 trillion that they're going to be getting and implementing is eliminating that repo market because they're just going to be lending the money out. So different banks and institutions don't have to go to each other for overnight lending. They're going to go directly to the Fed to help support this market. Because things shut down so quickly, they had to step in. One thing I do want to point out, between what the Fed's doing and what Congress has done, is completely different than the financial crisis. Now, what they learned in 07 and 08 was that you can't just throw little buckets of money around. So you remember the TARP program, that was a couple $100 billion. What they learned is if they tiptoe around some of these issues and don't really step up to the plate, then that's what causes major financial institutions to collapse, i.e. Lehman Brothers or Bear Stearns or almost the fallout of AIG. And what they did this time is they took that bazooka theory and they upped it to a nuclear warhead, essentially. They said, look, we're going to throw a large amount of money at this in the tune of $6 trillion, for the Fed, two from Congress as a direct stimulus to the economy. And they weren't messing around, meaning they actually took a large step instead of baby steps, which I think has a potential to avert a major crisis because you can't just shut down the economy for 1 or 2 months without seeing significant ramifications across the board. So I applaud them for doing it. We'll just see what the ramifications are from that moving forward. So the CARE Act. So this just got passed not too long ago, and the CARE Act provides $2 trillion in stimulus. So those include, and I'm sure everyone's read, we put out pieces earlier this week and emailed to the clients on the specifics of the CARE Act. It's really going to help small businesses who need capital for short-term financing. I believe that rate is going to be around, it's a 2-year loan for small businesses. The interest rate is 1%. So not that expensive as far as financing, and it's based off of payroll and healthcare benefits of a company as long as you're under 500 employees. So there's going to be an overwhelming number of people that are applying to these small business loans, as well as the $10,000 grant. It's definitely needed, specifically the small mom and pop shops who didn't have the capital on the sideline to weather, let's say a 6-month slowdown in the economy. But $1,200 per adult, $500 per child. Obviously, that's got income limits. $75,000 for an individual, $150,000 for a couple, and it tops out at $99,000 for an individual. So if you're there, you can phase in from 75 to 99. But if you make over 99,000, you're not going to get anything. And it's $500 per child. The child is considered anyone 17 or younger. Increase unemployment benefits and broader eligibility. So they're going to potentially be increasing the check amounts that that unemployment recipients will be receiving. There is going to be temporary student loan relief, emergency grants for small businesses, which we've covered, small business loans for payroll and rent, forgivable if no one is let go through June. Now, it's not all forgivable, but portions of it will be. Small business relief for existing loans. 58 billion going to go directly to airlines, 100 billion directly for hospitals. Fully refundable tax credit for distressed businesses to help keep employees on payroll. Funding for child nutrition, SNAP, which is food stamps and food banks. 275 billion for state and local government COVID-19 response efforts, and then 150 billion for state and local government running out of cash because of COVID-19 responses. So the big question is, I saw Nancy Pelosi came on earlier today and said, you know, we need to get another package up and running. I think it's good to start talking about it, at least have a game plan in place so you don't have to rush. We know that Congress doesn't come back into session until the end of April. So having those ideas kicked around between now and then is going to be helpful in the event that we need to actually provide more stimulus to the economy, depending on how quickly we can flatten this curve. So the CARE Act, if anybody has questions on this, we've had a chance to read through it. So make sure you send us an email or give our office a call. Or if you have friends or family that have a small business and just don't know how to navigate it, make sure you give us a call, 702-878-3900. So how long till we recover? And this is, you know, a really important question, you know, the peak to trough numbers, but this goes back basically to 1956, and it looks at all the bear markets and how long it basically took them to recover. And if you look, the average bear market decline from 1956 till now is roughly about 30%. It took 12 months for that bear market, and about 20 months is the average for the recovery. Now you can see in some of these situations, it took a lot less. And then in other situations, like in the dot-com bubble or the financial crisis, it took a lot more. So average bear market, if no recession hits, it's about 10 months to recover. And about 20 months for average of all bear markets. So it's just something to keep in mind as far as potential for recovery. Obviously, this doesn't reflect your individual portfolios, just the average S&P 500. One positive note to mention is that, you know, why we think we may have a high probability of seeing a pretty fast recovery in the third and fourth quarter, or at least definitely the fourth quarter and going into 2022, is because the economy was on an upswing before the trouble started, right? Before the virus hit, we actually had significant amounts of progress in the general economy, low unemployment numbers, and increasing factors for GDP growth. And we finally got trade deals done with significant countries, which would help with GDP growth. So those are positive backstops to an underlying foundation that just has cracks in it now because of these, what we call these temporary earnings gaps. Obviously, we want to focus on the long term. Stocks rise over the long term. So this gives you a percentage of time stocks rose over a rolling time period. This goes back to 1928 all the way to 2020. And what we want to focus on is, you know, what I tell clients is, you know, when we've been doing our reviews, first thing is that your portfolio isn't always a direct reflection of the stock market. So when we're doing these reviews, instead of looking at peak to trough numbers, I think it's so much more important to look at either your 401k balances, your 403b balances, your 457 balances, or your individual retirement portfolios, and look at them, where were they a year ago? And where are they today? I think that those numbers will provide some form of relief when you actually look at the long-term trend, right? Investing is for the long term. We want to maintain long-term exposure in really good, healthy companies or funds. And if you look over a 1 year period, you have a 68% chance of having a positive rate of return. Over 3 years, 76, over 5 years, 78. And you can see this trend continuously increases. Also, big annual declines are very rare. So instead of focusing on the negative, what we always try to do is look at the optimistic side of things. We have a saying here at Whalen Financial that optimism is the only realism. And you can see overwhelmingly that we have much more positive years in the market than negative years. Also, these big ones, only two. So this goes back all the way to the 1950s, and it just looks at every single year what the stock market did between these ranges, okay? And these big drops that we typically see are fairly rare, right? The big annual declines. We actually have a lot more positive 25% gains. You can see all these years here. Than we do negative 25%. Also, why we try to tell our clients to stay invested. Now, there's a difference between staying invested and exchanging risk assets for other risk assets, right? Meaning if you're rebalancing the portfolio. But to sell and go to cash is probably the least prudent thing for the large majority of individual investors. And the reason is because the people that want to try and time the market generally miss it, and it can cost investors significantly. So what this looks at is going back to 1990 to 2019. What this shows is essentially, let me go back there. What this shows is essentially, if you would have stayed fully invested from 1990 to 2019, you would have averaged 7.7%. Okay. So over that period of time, from 1990 to 2019, the S&P 500 would have averaged 7.7%. If you missed the best one day of the year, your rate of return drops to 3.9%. If you miss the best 2 days of the year, your rate of return drops to 0.8%. So just missing the 2 best days of every year, your annual rate of return went from 7.7 all the way down to 0.8%. That is a huge difference for only missing the 2 best days. Now we get into missing just the 3 best days. Now you're negative. Missing the 5 best days of the year, -6. And if you miss 20 of the best days of the year, your average rate of return from 1990 to 2019 is -27%. So this gets back to the fact of time in the market and not timing the market. Owning good, solid companies over a long period of time and allowing Mr. Market to do what he's going to do and what he's done historically, and stay fully invested. And here's another slide to kind of reinforce that. This looks at the chart of that pullbacks definitely happen, right? So what this shows is the blue is the total return for the markets each year, going back to 1980. The black dots then show what the maximum decline was in any given year. So at any given point, the market was down these throughout the year, but finished here or here sometimes. So the average pullback is about 13.7%. You can see that here. We just took that average line. So let's look at last year, okay? At some point, the S&P 500 was down 7%, but yet finished above 30%. And this is why you just don't know. So if you look here, back in 2018, if you remember the real big sell-off going into the Christmas season of 2018 during the China trade war, the market was off 20% at its low, but finished the year only down about 2 or 3. Another positive note is that earnings have grown over time. You can see this goes back to 1948. Earnings have consistently grown from left to right. And the average S&P 500 company earnings growth rate is roughly around 7%. So owning good companies that show strong economic moats around them is positive over the long term. And then this just kind of looks at, can stocks predict the next president? And it's got a pretty good indicator of if we're in a recession. I believe about 70% of the time, it accurately predicts who's going to be the president based off of which party is the incumbent and what the economy is basically doing. So it'll be interesting to see how this slowdown in GDP and this potential recession impact the 2020 elections. So what I wanted to do next is just kind of show you the overall marketplace and what we're looking at. So this is our flagship fund, which is Alger Focus Equity. So what we do in here in this strategy is essentially own 50 US large cap names. Some of those names are Amazon, Microsoft, Apple, Visa, United Health Group. And what I wanted to show was the simple fact of not looking at peak to trough, but over a trend line. So where we're at the current price basically brings us back to June of last year, okay? And from the start of the year, 39.53 down to 34, which is about 12%. Now compare that to the S&P 500, which is off almost 21. So owning these big US large cap company names is something that we're very proud of. And if I look at the S&P 500, I zoom this in just a little bit. This is that point that I was talking about. That was the bottom basically on 323, 324. And we saw this pretty significant rally to the upside, testing, and we've come down a little bit. I would not be surprised if the market retested these lows or consolidated is what we really want to see is a period of consolidation over here before trying to retest the upper resistance bands. And it's going to be based off of where peak infections are over the next couple of weeks. But that is our presentation. I want to thank everybody for coming on. Remember, the CARES Act just came out. If you have any questions, make sure you give our office a call. And we would love to hear from you, 702-878-3900. You can always email me at andrew@whalenfinancial.com. And I just wanted to thank everybody. We're going to be doing these hopefully on a weekly basis, depending on what's happening in the market and the economies. And thank you for your time. Stay healthy, stay safe.